We have no exposure to the wharf at all, and the problem with it is it was always essentially sort of overflow space for the city, but it created a fantastic type of structure for businesses that wanted large trading floors, etc. There's just too much of it and not enough demand. The estate is looking older, but as a mixed-use environment, particularly as a almost like a new town with a lot of residential. Yeah. It will thrive, and it's essentially going to reinvent itself.
It's ironic. I don't know if either of you have been down there recently, but I always thought it was, quite frankly, what you said, great for city companies, pretty crap to live in. Now, a lot of people who live down there are saying, actually, it's really nice down there now. It's got a great atmosphere. And I was there a couple of times. I was like, it's got it, just walking around. I'm doing the old Andy Brough from Schroeder's anecdotal thing. And actually, it feels a bit more atmosphere down there now.
Absolutely. And you've got the water, you've got lots of light, you've got a lot of open space and superb communications back. Coming west.
You and I were there together. We were in the car park. I was in a Fiesta. She was skating around doing wheel spins in a German sports car.
Yeah, those were the days. I think we both traded those cars.
We're going back about 12 years.
Exactly. Let me just segue over to Germany, because you are very exposed to the German residential market in particular. Just looking at a Deutsche Welle article, and it was talking about the German housing crisis, like winning the lottery, which captured my interest. And there's apparently a shortage of 800,000 apartments in Germany. What's the upside here? Because we know there's been a correction phase on the pricing. What are the supply-demand dynamics now?
Yeah, I mean, simply there has been a huge correction in the listed companies' valuations. But the fundamentals are that if you regulate a market, so you restrict your rents, which benefits all the people who have a flat or have an apartment, but of course you then create a huge waiting list because the real estate community isn't going to build more flats if they're limited at the rents that they can rent those apartments out at. So it applies to both Germany, but also to an extent to Sweden, where you have this heavily regulated market, and you end up with a shortage of units being built. So we're going to have to see a change in policy, and also a move to lift rents to a little more closer to market, which is, rents are governed by the Mietspiegel, and we will see that rent table increase. So I would say that from our point of view, you're investing in companies that essentially have 100% occupancy. That if a tenant was to leave, and in some instances you can actually then sell that flat to an owner-occupier, there's a real kick-up in value there, and we find that particularly in a business called Phayre-Mudge Deutschland in Berlin. So that's a really interesting company for us. But yeah, it's just it's like bulletproof income, I suppose, is the way to look at it.
Let me pop back to, I think, where you both started this conversation, and it was talking about the cost of finance and the central banks. Is there still a school of logic, and certainly this is pervading in certain parts of the US CRE, that there is a wall of money that needs refinancing that is underappreciated how dramatic that's going to be, and that's going to create a fire sale in certain parts of CRE. Is that something that you're cognizant of, or you believe is the case, or it's just not going to happen?
Yeah, I think it's the answer is unfortunately always a mix of both. Yeah. Unlike the GFC, which was a situation where the cost of money shot dramatically through the roof, plus availability collapsed. This time around, the cost has gone up, but there's still a lot of availability. So these businesses that do have refi coming up, they will be able to refi. It's just a question of cost. And for a lot of private equity-backed vehicles, that's going to be a problem because they're going to have to put more money in. For the listed companies, where us as independent shareholders really stop them from leveraging themselves heavily. We have across the space, we have leverage at about 33%. Across all our companies across Europe. That's a very comfortable place. So they're going to be the beneficiaries of these forced sellers when they come out. But even for the forced sellers, we don't predict a wholesale collapse. It's just going to be, the debt is there, it's just a question of price. Yeah. But there will be people, you will see headlines of people returning keys to the lender.
No, fascinating.